Okay. What's up, everybody? All right, so I didn't plan this ahead of time. I just happened to see the news and figured, you know what, I'll just throw it on a live stream. Makes it easier than trying to follow along. So I figured I'd jump right in. I think the only thing that got slapped harder than Chris Rock might be UI's path. Hey, Chris, what's going on, man? Hey, Chris, actually, if you want, I don't know if you follow UiPath a little bit. If you're free and you want to jump on, let me know. I'd love to get your take on what's going on here too, if you happen to be around. Um, but this afternoon, I was coming out of working today, and I saw the absolute crash that we witnessed in terms of UiPath's earnings. What's happening here? This is not a stock that I own, full transparency, but it's got a lot of attention. It was picked up big time by Kathy Woods, and then just in general, really, I wasn't sure what happened or why earnings were so bad. So I want to run through some of the earnings deck here, give a little bit of background into what UiPath does and what sort of RBA is in general. And really go from there. So I think it's not one of those things that has to be overly complicated, but for what it's worth, I think it does say a lot that there was quite a bit of surprise here, which speaks to the fact that folks got pretty much really crushed here in terms of earnings and what happened. Just give me 1 second, just resetting something on my end here. Sorry. Cool. So here's the nutshell, right? The stock dropped up to around 20% after the outlook really fell quite short of what Wall Street was expecting. Now it's actually come back up a little bit, and I'll check that in a minute to see where we are. But I want to go over sort of like the bad news before I get into what my take is on the earnings and what things look like from that perspective. So first and foremost, we saw a pretty significant drop in the extended session after earnings came out, right? And again, we're talking about UiPath here, which is essentially a robotic business automation software, right? It's sold in lots of different ways. But it was sort of an odd time because we saw this price actually close 48% below their IPO price. And they've only been really about just under a year, about 11 months since their IPO. So they're not looking so good right now, right? So just the quick and dirty of this is the company's forecast was originally for revenue of about 223 million. Excuse me, 223 million, somewhere in that range, about 225 million, and they were expecting an annualized renewal run rate, typically ARR, right, is what we call this, of about 960 to 965 million. So this is for the first quarter, right? Analysts that were looked at from FactSet had an expected revenue rate of about 247. So quite a bit higher, and an ARR of 968. So in both cases, quite a bit higher than what they were calling for themselves. And this is sort of what we get used to with analysts nowadays, is this sort of reaction of the company says one thing, the analysts disagree. And then when the analysts are wrong, the stocks absolutely get decimated in after hours trading, after they release their earnings. So this unfortunately is starting to feel like just another day of seeing the same exact thing again. But let's just talk about this for a second before I jump into some of the weeds. So for the full year, UiPath is essentially expecting revenue of about 1.08 billion to about 1.09 billion and an ARR of 1.2 to 1.21 billion. So again, though, analysts are forecasting revenue of 1.26 billion and an ARR of 968.2. So they're looking for much more revenue, but quite a bit less on an ARR perspective. The other thing that came out during the earnings report that was sort of concerning, maybe is the right word for it, but their chief revenue officer, Thomas Hansen, was basically set to leave, but he's agreed to stay until the end of the first quarter. So a little bit of stability, a little bit of training on how it's going to happen. And then additionally, we found out that the company appointed Chris Weber, who comes from Microsoft, to be the chief business officer. So here's the nuts and bolts of it. I'm still going to walk through the entire report, but I just want to give you some brief details here. Their fourth quarter reported earnings were a loss of 63.1 million, which essentially works out to about 12 cents a share versus net income of 26.3 million in the year ago period. So just going to read that back to you, right? They had net income of 26.3 million 1 year ago, but in this most recent fourth quarter, we saw a loss of 63.1 million. So adjusted earnings, which for those who are not always sure what this is, this basically means they're excluding SBC or stock-based compensation expenses and other related items. So we were looking at about a 5 cents per share there compared with a 9 cents a share year over year. The good things that we saw, not a lot, but some good things. Revenue rose to 289.7 from 207.9 in the year ago quarter. So one more time on that, they rose by approximately 82 million or so year over year, quarter to quarter, right? The company's ARR also rose 59% to 925.3 million from a year ago. So things look like they're on the right track. We're progressing. All good things to be aware of. Now, the sort of question at play here is that analysts had continued to put out an estimated earnings of around 3 cents a share on revenue of 283 million, with an ARR of 902.5 million, based on the forecast revenues of 281 million to 283 million, and ARR of 901 to 903 for the fourth quarter. So, look, that's the only stuff I'm going to read to you that's going to be really boring here. I just want to get that out of the way to say there were some expectations that were missed. There were some expectations that were hit. Overall, I think it's just all things we have to consider here at scale to basically step back and say, like, what the heck happened here? The first thing I want to also call out too, if you're not familiar with UiPath, they work in robotic process automation. And typically what we look at is tools like these folks are for large scale end-to-end automation, right? So the idea behind this is they want to replace with their solution anything that can be done in an automatic or quicker way, essentially, right? Where they're replacing what a normal human might have to do. They're using automation to do this at scale. Actually, earlier today, I saw a video. Oh my gosh, I'm gonna completely forget who hosted the video. But essentially, what we saw earlier today was like a lot of folks are starting to say, look, automation is really step one to AI, and I would agree. So, UiPath is in a lot of ways in a good spot. They've got a lot of good customers. I'm going to jump into earnings in a second here and really talk through it. But I did want to just call that out that they're doing some really good things. So let me just share my screen and start jumping into some of the things I actually really want to talk about today. Bear with me for 1 second here. Okay. I hope everyone else is doing good tonight. I appreciate you jumping on. Okay. Sorry about that, team. I'm just moving slow motion here. All right, where are we here? So first things first, I want to pull up the pricing as it stands today before I jump into everything else here. Yeah, hey, Rudra, I will, and I appreciate the thought process there too. So look here in a nutshell is. Oh wait, you know what? I don't know why that's not showing the right way. Give me 1 second here, team. There we go. Cool. So look, here's the deal. Okay, we saw this thing get absolutely smashed in after hours. Nothing new here. This is sort of our par for the course that we seem to be expecting nowadays all the time. But in essence, what we saw was earnings came out. We initially had a relatively rough day today, down about 7.5%. In after hours, we've come up a little bit, but we're down still close to about 14%. So overall, this is a really bad day. And before I jump into actually talking about the earnings and all the associated pieces of that, what I want to call out also is the fact that I do another video series on selling put options and generating premium for income. What I wanted to take was a moment to really share if you're following strategies like selling put premium, which is a really interesting way to generate income on a regular basis. The one thing I would really urge everyone is you absolutely, unequivocally have to ensure that when you're deciding on where you're going to sell those put premiums, you have to absolutely make sure that you know if there's earnings coming up, if there's significant events coming up. All the technical analysis in the world will not matter if something drops 14% in after hours trading, and you would be really up the creek without a paddle here and potentially for a long time as well. So I just want to really call that out, broadly speaking here, because you really don't want to take chances with this kind of a thing. It's very important to understand the risks and what can happen. Hey, Lance, what's going on? Yeah, a lot of comp for sure, man. So let me shift over real quick here. I just want to jump right into the earnings piece. So let me just get to there. Okay, bada bing, bada boom. I'm not used to doing this on Chrome, but I realized the other day that was the problem I was actually having here is I couldn't quite share it. So here we go, right? This was their earnings for the fourth quarter of 2022. This came out earlier today. And I think that for what it's worth, there's a lot of really good information in here to understand and share. But there's also a lot of things in here that are a bit concerning too, from my perspective, as someone who looks at these on a pretty regular basis. Cool. So let's jump right on in, right? Oops. Boy, oh boy, guys, I'm having a hell of a time today. So I want to call it out full transparency. I don't work with UiPath. I'm not engaged or affiliated with them. These are their decks and presentations that they've shared. I actually have not previously looked at these, so I'm doing it live just to give you a feel for sort of what I'm looking at and what's important here. And as always, these are important slides right here to understand safe harbor and non-GAAP financial measures. Safe harbor essentially is saying that there could be things in here that could change in the future, and they're making assumptions based on what they believe to be true, but they may not be. So just know that going into this. And then additionally, there can be some financial measures. We see this a lot with tech companies, especially in certain spaces, where they can sometimes skew or get slightly outside of the norm in the way they measure things, the way they label things, the way they look at data. Just know that going in, it's not the end of the world or anything super concerning. Um, but this for sure is something to be aware of, that non-standard measurements can affect the way stocks hit the street and the way analysts ultimately measure them. So for what it's worth, this is always one of my favorite slides in every presentation. I call it the happy slide. The happy slide is where they really want you to stop and make sure that you're seeing everything in here. So UiPath at a glance. 925 million in ARR, right? That's annual recurring income. That's sort of their SaaS model, that renewable business. 59% ARR growth rate year over year. So high double digits. That's a great rate. They have over 10,100 plus global customers. Now, I'd be curious to see what the size is there. And of course, they answer it next. Over 1,493 customers with an ARR over 100K. This to me, for a lot of companies in this space, especially the automation space, where they're coming in, they're replacing process, replacing automation. We want to see them being really sticky. And really sticky means we're seeing high retention rates. We're seeing high NRR or net revenue retention rates, where they not only do they get a customer, but that customer grows over time with them. And of course, as you can probably see on the screen, that's the very next thing we're going to talk to is 145% dollar-based net retention rate. So looking just here, this feels like a great business. It's almost $1 billion in ARR. They've got great growth rates. They've got a huge customer base. I'm sure that a lot of those are very small, probably micro automations that are happening within the orgs, but still, it's okay because they've got a base of over 10,000, almost 1,500 on over 100K a year in ARR, and then 145% dollar-based net retention rate. So that NRR piece is really, really important, because what that's saying is for every dollar that they bring in, they end up spending another $1.45 by staying with the company. That's a huge thing. And again, the reason I started the call talking about where they missed on earnings, what I want to really call out there was those are per the analysts and per Wall Street. And so sometimes the problem is when you get caught up with earnings and you get caught up with what analysts want to hear and see, the issue many times can be that the company never said this is where they're going to be, right? Chris, I'm gonna talk to that in just a second here, because I think it's a really good call out here. Automation is not that hard. Okay. The reason why we see some companies in like the integrated AI, machine learning, deep learning, neural network space, those things are hard to build. It's very hard to get a moat. It's very hard to master that data cycle and get it to work simply. RBA does not have to be that complex. If I want to get something started, relatively quickly, I think RBA would be my route versus a full-blown platform with integrations across the board, right? But again, the key call out here is automation is often the first step towards full-blown autonomous AI, machine learning, et cetera. So something to call out there. Wow, great comments here, by the way. I just have to call this out. I would say Ray Donovan is really like the Sean of TV, to be totally fair, team, but it is what it is. So just to keep going here, right? Again, these are good numbers for the most part. We've got strong customer momentum. We've seen a growth year over year here, and that's an important comparison. Is total customers have gone from about 7,900 to 10,100, right? That large customer base we mentioned in the previous screen, the 100K plus ARR range, we've jumped up. Look at that rate. That's huge. From just about 1,000 to almost 1,500. That is huge. That's great. And this is a big and very interesting metric, one that I almost always take caution of when I look at earnings reports, the becoming C-suite priority. Wow, that's a really interesting metric when you think about it. I never thought about it in terms of putting it that way. I would love to see some of the other companies. I'd love to see like a Palantir. I'd love to see a C3. I'd love to see companies like that start talking more about C-suite priority. What a great way to talk about this. And I want to take a pause here. This is really the challenge that a lot of our companies have, in this space in general. Is it's not hard to sell your product in. It's not hard to launch a freemium version of it. And truthfully, in the world of tech, it's not hard to find 100K a year, by the way. What I want to call out though is that $1 million mark. I work in this business. I can tell you guys firsthand. Majority of the deals I do are in between that sort of 200 to 700K range. The $1 million mark is where you absolutely have to have C-suite integration interest, and oftentimes what we call executive sponsorship. That means someone who holds ultimately the large paycheck, who has to either go to a PE board or a public board or someone they're working with internally to get this thing signed off on. This is a big deal. And so this is an interesting way to basically pull this out, I'd say. I haven't seen anyone else really call it this, but I love this. So essentially, their customers that spend over $1 million a year in ARR has gone from 89 to 158. So that's a really cool metric. And what I'd call it too, I'm a big fan of investor presentations for those who don't know that already. But really looking at the efficiency of how they acquire customers, this is a big deal, right? This is that customer acquisition cost that then translates into that net retention revenue. So something to call out there to be aware of as well. So let's talk about a couple of different pieces here. So the UiPath Automation Cloud is essentially where they have automation cloud robots, right? We're looking at 140 million in cloud ARR, 27 months since it first was launched. 55% of new logos in Q4 adopted cloud products, and 3,800 customers using cloud products. So let's just take a quick pause there. Since give or take around 2014, 2015, and then accelerating into 2016, 17, and 18, what we saw was this thing that we often called a bridge to cloud. A bridge to cloud was the motion that many, many, many vendors out there who had legacy software and technology systems that were based on hardware. So when you think about hardware, think the gigantic refrigerator-sized servers. That's where they kept their data. That's where they did their processing. It was often stored in the basement, in a closet. Maybe they had to own their own warehouse and they had to have a team of people managing it. This move to the cloud is where we see things like Azure, IBM Cloud. We see AWS. We see lots of folks out there in the cloud space. This move to the cloud, Chris, I'm going to call this out. Sometimes I say this on my channel. There's certain topics I can't talk about. This is specifically one that I cannot talk about. But maybe soon in another video, Chris, you and I can talk about this just to call it out. This move to cloud is really big because what it does is it allows customers to scale faster with more elasticity. So instead of having to go and measure how much room is left in the basement and turn the AC on higher to fit another gigantic server rack in there, they can simply just go to AWS and get 10% more storage or space, 10% more processing power, etc. So something to call out there that this is a big move, and this also helps UiPath scale a little bit faster as well. Now, one of the biggest things here, I just want to make sure these, yeah, I didn't think so. So one of the biggest things I want to call out here as well, and we talk about this with a lot of great companies, IBM, Salesforce, Oracle, Palantir is now launching their ecosystem. This UiPath ecosystem, and I want to share it on the website in a minute because I was actually kind of surprised even when I saw it. They have a massive partner ecosystem. So they want to be able to work with, in, and around a lot of different types of technologies across a lot of different use cases. And if you think about what automation really does at scale, without the ability to integrate to a lot of different sources, you're going to miss the boat in a big way here. So again, right, they've got over 5,100 business partners. They're consistently investing in this space according to the slide here. And the goal here is to enable digital transformation journeys. But let's pump the brakes for a second. There is a big difference between having partners and having folks who are truly dedicated just to your services. So I'll give you an example. Google, Salesforce, IBM, Oracle, all of the big companies, and a lot, the Tableaus, the Lookers, the Clicks of the world. A lot of times we'll find companies will say, those are our partners. The reality is anyone who's watching this, you typically can go set up your own little consultancy and become a partner of almost any major technical company out there. Maybe you have to pass a certification or something like that. But essentially to sign up at a base level and provide services is not that hard to do. I'm not, putting them down here or saying this isn't great. It is great. And of that 5,100 plus, I bet many of them are very, very good. But it is important to understand that a partner can mean a lot of different things. It could be someone who helps them sell the software. It could be someone who helps install it. It could be a marketing partner. It could just be a sales partner. It could be a general SI partner. When you think about the Deloittes, the Accentures of the world, the PwCs, they're just out there to install whatever people want. And this is just another sort of tile they're going to hang on their wall to say, yep, we got them covered too. So in this gigantic project, we can handle that as well. Just something to be aware of. The ecosystem is important. It does drive value. It does help the company out, but everybody's really doing it, and it doesn't necessarily mean anything. I usually like to understand where the partner programs are broken out and understand what kind of revenue can be tracked back to that partner program. So just something to call out, because I think a lot of folks who don't typically travel in and around the tech circles or work in them, it can seem like that's an amazing thing, and sometimes it is, but it isn't necessarily a huge big deal. So just keep that in mind as well, okay? Let's jump into the financials a bit here, right? So we already covered this a little bit in the beginning, but I want to speak to it again because I think they've laid it out really clean here, right? 290 million in revenue, and I just have to lean forward to read this, right? That's year over year ARR growth rate um, for Q4, 925 total million in ARR, 107 million net new ARR. So not bad, right? That's a pretty good growth rate for net new business. 39% revenue growth rate year over year, 59 ARR growth rate. Numbers look good, right? Numbers all seem to look really good. So the question is, what's going on? Why are we getting crushed in after hours? And I don't want to go over all these specific things, but I thought this was really interesting here. I just scanned through this really quickly before I shared my screen. Wow. I don't know if anyone else has really thought about this in terms of earnings coming up in the next couple of months here. I'd be really curious for those who are watching this. Like, I got to be honest, I wasn't expecting them to call out Russia and FX issues. I had no sort of even thought process here to expect to see it. Hey, Josh, I'm going to talk to that in just a second too. I want to call that out here. So this Russia piece, I really am starting to wonder where and how I have to hedge for this with earnings that are coming up, or just get a feel for if they're seeing big effects, who else is seeing the same thing. That to me is going to be a major concern that I hadn't really thought of. I mean, I'm aware of things going on with Russia from the stock market perspective. I think it's easy to say things like it's built in already. We sort of understand what's happened from the pricing perspective, but from an earnings perspective, for those who are shutting down business overseas, cutting ties with Russia, listen, Russia as a country and as a sizable place, there are a lot of companies in there. They're probably using a lot of this technology. That's something to really consider. So I'm going to read these off just because I think it's really interesting that their FY23 ARR guidance, they expect a $15 million reduction in full year ARR due to the Russian shutdown. And they also expect a 20 to 25 million FX headwind. Well, that's pretty interesting, right? So they're going to get beat up on FX and from a Russian perspective as far as what's happening between Russia and Ukraine, of course, which is above all of this stuff, extremely terrible and far exceeds caring about earnings, of course. Their 1Q23 ARR guidance, they're expecting another 5.5 million reduction to first quarter ARR and another 5 to 10 million in FX as well in first quarter ARR. That's really interesting, right? And the full year numbers for revenue guidance for 23 is a 25 to 30 million FX headwind, as well as a first quarter 23 revenue guidance of 10 to 15 million. Wow, that is pretty crazy. I think it's brilliant that they call this out. I think it's really great that they put it in writing and let people know what's going on. But as an investor, that's also pretty scary to think who else is going to be affected to this degree. Now, in general, here's the guidance that they're putting out. I always want to call this out too. Like, oftentimes what we'll see is a company like UiPath or anyone else for that matter come out with their guidance. Okay, it's a really important. I'm going to put this up here because I think that's a really interesting call out. Their guidance is what they're saying they believe they're going to hit, and then we have the analysts who are going to come over the top and give their take on what we think is going to happen. And this is exactly what happened in this most recent cycle. Aaron's point here, right, is just going to become a situation where everyone out there who might have something going on can simply just say, yeah, you know what? We're really affected by what's going on with Russia and Ukraine, as well as dealing with the FX situation tied to it. You know, I think it's going to be interesting. I haven't seen anyone else really do this. I'm going to be looking for some of the major tech players to see how they address this. But my gut is with UiPath coming out and doing this, I would really expect other people to be doing the same. So just something to call out as well. My God, I fully expect Kathy Wood to come out and do the same thing basically now after the way she's getting beat up on this stock. So real quick, right? ARR guidance for first quarter 23 is 960 to 965. For FY 2023, 1.2 to 1.21. That's essentially billion, right? So I think it's a big call out here, right? And what I'm most worried about here, I don't want to go through all these things here, but what I want to call out is the fact that This is starting to see a trend now where there's more challenges than ever. Sure, and I would absolutely be glad to call this out, and I want to call it in a few different ways as well. I think the more of these presentations we go over and the more we see the way they're measuring things now, we're starting to get a feel for the fact that everyone's looking for reasons why things aren't going great or aren't working the way they want to. And now we have reasons we could put on paper to say, here's what's wrong and here's what happened. That's really, really interesting. I have been doing this for a very long time. I'm actually extremely familiar with the FX world, cross currency, the way we derive these prices and bring them back together. I've never seen someone pull FX headwinds as being a challenge for their business that we wouldn't have just expected in the business in the first place. So it's very interesting to think that that's something we're now looking at or using as part of our investor deck. So real quick from the hedging perspective, I just want to call this out. Like, depending on the size of your position, how long you're planning to hold it, and what your risk tolerance is within your portfolio, and then additionally how big this is from a portfolio position, there are a number of different ways to think about hedging it. If you're not planning to do anything, you're holding this long term, and you don't care if it goes down, you're going to hold it for another 20 years. I think you don't do anything, right? You certainly can think about doing something, but you don't have to. The easiest way to hedge in and around earnings is to form what we call like a married put. I sort of use my own term, which is really like a dating put. For very large positions where I'm not sure or I'm not clear on what I think the earnings are going to look like or how they're going to be reflected, what I'll do is I'll attach a put to my shares. So essentially, what I'm going to do is represent a certain amount of them in terms of buying a put so that I'm covered to take profit on any downside. This is the easiest way that I do this. This isn't, I want to be clear here because not because it's YouTube, but really, to be honest, I'm not a financial advisor and I don't know everyone's individual situation. So I would say really look at the risk tolerance you have and how big of a position you have, and if it's worth paying the premium cost to get the put protection on your position, right? If you have a really sizable position and you want to take some of it as a loss, that's not a bad play either to then play wait and hold and see when you want to get back in. I would say additionally, if you think that you own positions right now that could offer massive upside or downside depending on earnings, you can play options strategies like straddles, where as long as you cover the premium in between the two purchases, you can make money either up or down depending on how far it drops. Now, perfect example, UiPath. Um, Down, last I looked, it was around 14-15% in after hours. Assuming it's going to open up in a similar direction, you potentially can make a nice little return on the way down, and potentially if there's a big pop up again, you can make it again. But the most basic and easiest way to think about hedging for any position where you have a large amount of holdings in your portfolio and you want to try to profit from a downside risk, things like married puts are the best way to go, where you're just going to buy a put against your shares and then take some of that profit on the downside. That's the easiest, most simple way to think about it. But that's sort of the way I typically take it for what it's worth there. Now, one of the reasons I think we saw as far as this huge loss, I think they're calling it out. I think growth was not quite as strong as Wall Street expected it. If you look at the earnings that they're putting up there, they don't look that bad. Everything that investor deck spoke to a business that's growing like crazy, growing really well. And I think it's sort of concerning that we're seeing this time and time again uh, around sort of like what's happening, right? All right, I'm just typing something in here real quick. I want to see if there's any new news that just popped out since I started doing this. So let's see if there's anything different in here that I didn't mention real quick. Sorry, guys. Sorry. I know I hate to sort of give you the silence here when I'm looking at this, right? So this is the statement I was looking for. I couldn't find it right when I was launching the call. Yeah, no problem there. I'm glad to share that hedge piece. So here's what's coming in directly from the company, right? This is a quote. We're saddened by the war and humanitarian crisis that is unfolding in Ukraine, said Daniel Dines, UiPath co-founder and chief executive officer. We've built a global business that serves customers in more than 115 countries, including countries across Eastern Europe and Russia. Looking ahead, we feel confident in our market leading position in automation and prospects for future growth at scale, but believe it is prudent at this time to factor both our European exposure and go-to-market leadership transition into the financial outlook that we're providing this afternoon. So that's a really eloquent way to say things are not going to stay this good. These were really, really good earnings. We expect things to fall apart at some point. This is sort of that early warning to what's going to happen here. So, Rudra, I think that's really the big issue here is they're seeing senior leaders leaving. They're seeing continued pressure overseas from the Eastern European perspective. I think that is the kind of pressure that they're expecting is going to start to affect the top lines, the bottom lines, and some of that growth rate as well. So I don't want to go too much deeper than all that. I think this is really interesting. I think we're seeing a number of other things that are really cool in here. But to me, this is just an early sort of warning shot into the sky to say, look, we could be facing even more headwinds than we expect today. We're not really sure what they're going to be, and we don't know when this conflict is going to be resolved. So that's sort of where I am. That's my concern here. I said this right at the beginning of the call, but I want to say it again. This is also why you have to make sure you understand when earnings are coming out in and around the put selling motion, if that's something you do. And then additionally, what I would call out is the fact that we're looking at yet another position where ARK has gotten something really, really wrong. And I almost am starting to get this belief that anything that they do, I should just do the opposite. I know that sounds silly, but that's frankly how it's starting to feel. So, anyways, look, it's late. I appreciate everybody watching. I'm going to let you go. I'm going to dig into some more details here as well. And then maybe have a conversation with Chris Patel as well on sort of the RBA space, who's likely to be dominant here and who the next player to step up to the plate might be. So with that, thanks everybody for watching. Really appreciate the time and have a great night. Thanks for stopping by. See you, everybody.